Hey everyone, and welcome back to Tech Fails, the channel where we dig up the spectacular blunders, the forgotten flops, and the most jaw-dropping technology scandals that history has to offer. Today, we're strapping in and heading back to the late 90 seconds, the peak of the dot-com bubble. It was a time of endless optimism, where every idea, no matter how ridiculous, was worth $100 million, provided it had a .com at the end. Venture capitalists were throwing money around like confetti, convinced that they were funding the next Amazon. But for every Amazon, there were 10 Webvans. Our subject today is one of the most famous and frankly, one of the most spectacular failures from the .com era, Webvan. It wasn't just a failed project, it was a $1.2 billion logistical catastrophe. It stands as a symbol of everything that went wrong when boundless ambition met zero-sum reality. So, how did a company that promised to revolutionize grocery shopping become a cautionary tale in the annals of technology scandals and sunset products? Let's dive in. In the late 90 seconds, the internet was beginning to change how we shop. Amazon had proven you could sell books online, but groceries? That was a different beast entirely. Groceries are perishable, heavy, and require refrigeration. The logistics are, quite simply, a nightmare to manage at scale. Louis Borders, the co-founder of the Borders bookstore chain, looked at that nightmare and saw a multi-billion-dollar opportunity. The pitch for Webvan was simple, yet utterly transformative. The core promise was, never go to the grocery store again. This was the dream being sold to millions of busy consumers. Webvan wasn't just going to deliver groceries. They were going to reinvent the entire supply chain using cutting-edge technology and automation. Their promise was a sleek, seamless online experience. Customers could order anything from milk to frozen goods, select a precise 30-minute delivery window, and have it arrive on time every time. It sounded like the perfect modern solution. Now, let's talk about the money. Because this is where the story shifts from ambitious startup to certified technology scandal in the making. Webvan's initial funding was absolutely colossal. By the time they went public in 1999, they had raised over $1.2 billion in funding. Yes, that's billion with a B, an almost unbelievable amount for the time. Investors like Benchmark and Goldman Sachs were falling over themselves to get a piece of the action. Their IPO alone raised a staggering $375 million. This was a monster of a company, driven by hype and investor confidence. The market loved the story, pushing Webvan's valuation to soar to $8.3 billion at its peak. To put that in perspective, Webvan was valued higher than established, profitable supermarket chains like Safeway. The irony? Webvan hadn't even delivered a single citywide profit. The problem wasn't the core idea of online grocery delivery itself. The underlying fundamental problem was the execution, or more accurately, the sheer, excessive scale of the execution. Webvan's core strategic blunder, the colossal mistake that would eventually sink the entire operation, was their choice of infrastructure. They did not opt for the modest, lean approach of leveraging existing store locations. No. Webvan went all in on building enormous, automated, high-tech distribution centers, or megastores, as they grandly called them. These weren't your grandma's grocery back rooms. They were 500,000 square foot, climate-controlled, highly automated palaces of logistics, specifically designed by the engineering firm Bechtel. Each one was estimated to cost around $30 to $40 million to construct. That is an astronomical amount for a startup operating on a thin-margin grocery model. They were designed to be marvels of efficiency. Computer-controlled conveyor belts would zoom around, retrieving orders with minimal human intervention, mimicking industrial automation. They were modeled after the principles of just-in-time manufacturing, but adapted for highly perishable goods, which adds layers of difficulty. But here is the fatal flaw, the logistical paradox that broke the company. Webvan decided they needed to build these multi-million-dollar facilities before they had proven the business model worked in even one single city. They were building an infrastructure capable of handling $2 billion in annual sales per facility, assuming that the demand would instantly materialize to justify the massive cost. They were essentially building the entire highway system before the first car was even off the assembly line. The gamble was enormous. The first megastore was built in Oakland, California, as a test case. But then came major construction projects in Atlanta, Chicago, Seattle, and other major metropolitan areas, all simultaneous. They sunk hundreds of millions into concrete, steel, and high-end automation. But because they committed to building so much capacity so quickly, they had massive debt and enormous overhead expenses. All of this crushing cost was incurred before they had scaled the customer base necessary to cover even the basic utility bills. They were burning cash fast. The automated warehouses looked great on paper and in glossy investor presentations, which is often the case with the technology scandal. But in reality, they were prone to spectacular, systemic failures. When the technology did work, it was often found to be vastly too complex for the job at hand. Remember, this was the absolute dawn of serious e-commerce logistics. The software Webvan was running had to track thousands of SKUs, manage perishable inventory across multiple climate zones, and coordinate orders with their fleet of delivery trucks. Furthermore, it had to interface seamlessly with the complex automation hardware, all in real time. This was a truly monumental technological task. Unfortunately, the systems simply weren't robust enough for the demands placed upon them. System glitches and breakdowns were common and costly. Orders would be mispicked, sometimes dramatically. Imagine ordering a carton of eggs and instead getting industrial-sized cans of pickles due to an automation error. Worse still, the high-tech automation often required more, not less, human intervention just to diagnose and fix errors. The technology was not self-sufficient. Labor costs, which the automation was supposed to minimize, actually spiked. They had to hire specialized engineers and technicians just to keep the complex systems running and synchronized. Their delivery model was another major Achilles heel in this massive technology scandal. Webvan promised consumers incredibly tight, precise 30-minute delivery windows. This is incredibly difficult to achieve reliably, even with the sophisticated tracking and mapping available today, let alone 25 years ago. They use dedicated, temperature-controlled vans to maintain quality. However, they failed to account adequately for the unpredictable variables of real city life. Factors like debilitating traffic jams, apartment buzzer issues, and customers simply not being home during the short window created chaos. As a result, the delivery operation was a leaky sieve, constantly hemorrhaging money on gas, labor, maintenance, and delayed goods. The core business flaw was this: every single delivery cost Webvan more money than the order brought in from the customer. This is the definition of a fundamentally flawed business model. The only way to succeed, in their view, was to scale massively. But scaling only accelerated the rate at which they lost money. It was a race to the bottom, funded recklessly by venture capital. The most fascinating aspect of the Webvan saga is the almost reckless desire to scale at any cost. They bought a competitor, Home Grocer, in an all-stock deal. This merger was worth $1.2 billion, a deal that effectively combined two hemorrhaging companies into one giant, faster-bleeding operation. In its very short life, Webvan expanded aggressively to 10 major U.S. cities. This blistering pace overwhelmed its already fragile technological and logistical systems. Each new city added tens of millions in non-recoverable capital expenditures and then many more millions in crippling operating losses. Let's look at the numbers again, because they are staggering. Webvan was reportedly losing upwards of $10 million to $35 million per month. That is not sustainable for any business, let alone one trying to sell milk and bread. They also spent enormous amounts on marketing and advertising, convinced they just needed to capture the market share at any price. But because the underlying service was often unreliable and inherently expensive, customer retention was poor. They were paying a fortune to acquire customers who often left immediately after one bad delivery. The overinvestment in custom warehouses, the hundreds of millions sunk into non-recoverable assets, was the anchor that dragged the entire ship down into the abyss. They had built a capacity for billions in annual sales, but were struggling to hit $1 million a week in revenue across many of their markets. The moment of truth came in the year 2000. The dot-com bubble burst spectacularly, and suddenly, the easy money well dried up completely. The investment community, which had previously showered Webvan with cash, now wanted to see a clear, defined path to profitability. Webvan had no such path. They only had a path to faster spending. The writing was definitively on the wall. They had spent a total of $1.2 billion and still couldn't make a profit on a single, simple grocery order. They had built a spectacular technological machine, but the machine was designed to move dollar bills from investor hands directly to the trash can, with groceries as a costly, unprofitable byproduct. On the 9th of July, 2001, less than 3 years after its spectacular IPO, Webvan officially shut down its operations for good. The final chapter of this technology scandal is arguably the most heartbreaking for its investors: the painful liquidation. When a company shuts down, it sells its assets to pay off creditors. But what do you sell when your core assets are 500,000 square foot, custom-built, highly specialized grocery distribution centers? The answer is not much of value. The vast automated warehouses, the $30 to $40 million megastores, were sold off for pennies on the dollar to companies like Amazon, who ironically would later master the space. Over 2,000 employees lost their jobs overnight. The company that was once valued at over $8 billion simply vanished, leaving behind a massive trail of debt and defunct infrastructure. The Webvan experience became the textbook example for the phrase burn rate, the speed at which a company uses up its cash reserves. Webvan's burn rate was a blazing inferno that consumed everything. So, what lessons can we draw from the spectacular failure of Webvan? This wasn't just a technical disaster. It was a fundamental business model disaster dressed up in fancy technology. 1. The primacy of unit economics. This is the big one. Unit economics simply means, are you making a profit on a single sale? If you lose money on every delivery you make, you absolutely cannot make it up in volume. Webvan lost money on every order, and scaling only increased their total financial losses. Technology is only a multiplier. If you multiply a negative number, you only get a bigger negative number in the end. Don't build too much too soon, the scalability trap. Webvan's decision to build multi-million-dollar infrastructure before proving the market demand was an act of extreme hubris. They went for scale before they achieved proof of concept. Modern startups embrace the minimum viable product approach for a critical reason: test small, fail fast, and only scale what demonstrably works. Webvan tested a colossal, maximum viable product, and as a result, it failed just as colossally, draining billions. 3. The myth of the killer app for logistics. They assumed their software and technology would magically solve the complex, messy problems of grocery logistics. They neglected the boring, human element of the business. They failed to account for traffic, managing spoiled goods, and delivering excellent, costly customer service. Logistics is a hard, thin margin business. Technology can enhance it, but it rarely revolutionizes it overnight. 4. The dot-com delusion. Webvan is the perfect historical marker for the dot-com bubble's reckless madness. It demonstrated what happens when investors fund a company based on a great story and a massive addressable market. They funded it without demanding a sensible, profitable business model. The investors profoundly confused market hype with market reality. Today, online grocery delivery does work, but it works because companies like Amazon, Instacart, and established retailers like Walmart learned from the painful Webvan technology scandal. They used existing store footprints, avoided building massive, costly, centralized automated systems, and focused on using smart software to manage the last-mile logistics effectively. This last-mile logistics was the exact crucial part Webvan got fundamentally wrong. The failure was a masterclass in business model collapse. In the end, Webvan was a truly ambitious idea, a real glimpse into the future of commerce, but it serves as a stark reminder. The reminder is that in the world of technology, capital and ambition are simply not substitutes for a solid, profitable business model. It remains one of the greatest technology scandals and one of the most expensive lessons the internet has ever taught us. Thanks for tuning in to another episode of Tech Fails. If you like this deep dive into one of history's greatest sunset products, hit that like button and subscribe. Let us know in the comments below what other dot-com disasters or failed projects should we cover next. See you in the next one, and remember to always check your unit economics.